Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey, Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to the Australian Stock Market Show. This is the show where you get to learn about how to make more money in the stock market. You also get to be part of the show by asking us, the stock market experts, to help you through all of those things that may be holding you back. We also answer all of those burning questions you have, give you our views on the stocks that you're interested in, plus a whole lot more. Now tonight we cover some really exciting stocks, including Pushpay Holdings, Z1P, 3DP, Zell, Aristocrat Leisure and more. We'll also have some great questions, including one that will help you understand charts better, so stay tuned for that. Later on in the show, we'll present our main topic for tonight, and that is finding growth stocks in 2021, how to minimise risks while maximising profits. So stay tuned for that. Hello, I'm Janine Cox, your host, and joining me tonight is co-host Dale Gillham. How are you, Dale? And we're Australia's most trusted stock market educators. I was just so excited to introduce you.
You do it every week, so I'm not sure why you're actually surprised at all that anyway. But I mean, I know I was briefly looking over the emails, and really we have, it was so great to see a lot of people sending in some really, really good emails and thinking about what they're doing, not just asking us about what our thoughts are on a stock or asking for an entry or exit point. I reckon that's really, really fantastic what we've seen with the emails lately anyway. So
yeah, I agree. You know, I love charts and talking about charts, and I'm not going to make any excuses for encouraging everybody to ask about the stocks that they're interested in. However, I do know you want people to ask different questions.
Well, I do.
As I agree with you that in often cases that we want to hear not what we should be hearing, just talking about a stock does not empower people to be better investors or traders.
Yeah, so it's not about telling them what they want to hear, not what they should be. We're telling them what they should be hearing.
No, you often tell them what they should be saying. And
well, I know, but anyway, that's okay. But anyway, the purpose of this show, as you know, Janine, is to help people become independent, and that means teaching and not just giving them the fish. And no jokes about my fishing powers, please, as all I generally catch when I go fishing is just a cold.
Oh, yes. But the rod doesn't even bend over, does it?
No, my rod doesn't even bend. It's just, I just bend over the side of the boat. But anyway,
as long as you don't fall in.
As long as I don't fall in. Remember, this is your show. If you do have a burning question for us, don't just sit there, get active and do something, as you never know what might happen. Now, Janine and I are always talking with people who desire to be better traders but are not, simply because of the decisions they make today. Now, so it's really, really your choice to do something, do nothing, or procrastinate. Now, there's one thing I know, and that is if you do something, then something will happen, and maybe that has been holding you back from getting better results in the stock market. Now, maybe that might be solved tonight, but if you do nothing or procrastinate, then the outcome is absolutely guaranteed what will happen. So send in an email, or better still, upload a 30-second video of yourself to Dropbox and send us the link through to info@wealthwithin.com.au.
Oh, you just can't keep your hands still under the table, can you?
Hey, I'm going to keep on top of the table or I'll get in trouble.
Remember to send all your questions into info@talkingwealth.com.au and type Wealth Within Live in the subject line. As always, this is a two-way street, and that means right now you need to click on that subscribe button and we'll do our bit to answer your questions. Moving on, it is the third Tuesday in the month, and this means When I ask him to do it, he won't.
Drum roll.
We're going to look at world markets. This is serious. So let's get into the charts right now, shall we?
Okay, so what's on the charts right now?
Okay, if you put up what I asked then. Oh, yes, you did. Very good. Okay, so you can see the leaders board there. And at the top of the leaders board for the week, and now this could be slightly different, couldn't it? Today's data might not be in the system there, but we can see that for the week it was 1.33% as in last. Yep, for last night's data, and that was New Zealand leading the way early in the week. But it is early days.
It's okay. It's all right. I sanitized
I just don't want to reach across the desk too far.
I sanitised it. It's fine.
I get told off because my hands end up in the shot when you're speaking. All right. So look, then coming down from that, we can see the S&P 500 index at 0.65, and then below that we've got the obviously the All Ordinaries Index, which is flat, so you're my assistant there. Oh, thank you very much. Which is pretty well flat. I mean, nothing to get too excited about there.
Did you tell them we're missing a day's data?
I just did before, but you were looking at me a bit dumbfounded, so I wasn't sure that you understood what I was saying, so maybe the viewers didn't either. Okay. But basically what Dale's saying is that the data for today actually hasn't come through. It's not there, so we're looking at yesterday's data. So looking at that, we can see the Dow Jones for the month. So this is probably more relevant looking at the month rather than the week. The Dow Jones is actually leading the board for the month.
I know, it's been
pushing strongly, hasn't it?
And doing really, really, really well.
It's really surprised you though, hasn't it?
No, I was saying late last year when I was doing my interviews with Jim Beach for Talking Wealth, I was saying I think there's a changing of guard. I thought technology would slow and that the Dow stocks would perform and the Dow would do better than the S&P and the NASDAQ, and it has so far. Now, whether that's a trend that's going to keep going for the rest of the year, it remains to be seen. But out of the 5 FANG stocks, only one of them's in positive territory, and that's actually Google. Apple's down about 8 or 9%, or it was yesterday. I haven't looked at it today. So so it's right now the Dow is the market to be on.
Right. All right, now we can see obviously coming down from the top of the leaders board there, we've got the CAC 40 index 5.8%. Now, I don't know if many people are interested in that market, but I'll come down to something that's probably a bit more common. If we look at the DAX index, that's the German market there, 4.9%. European markets are actually up quite nicely. We're seeing the 4.47 there for the European index. And then coming down further again, we've got the FTSE 100 up 4.11. So quite nice across that Europe area of the globe. And then we come down, we've got the Nikkei stock average at 2.77%. India is actually low. Now, India was actually doing really nicely for a while.
With New Zealand, it was a stellar performer last year.
So that's come back a bit, obviously, as well, relative to the rest of the board. But if we come down further again, you can see Australia, the All Ordinaries Index, up 1.13. The Hang Seng's actually down 0.5% at the moment, and the Shanghai Comp's down 2.5. So Asian markets have taken a bit of a turn and are on the bottom of the board. But look, it's only the month we're looking at here, so we should have a quick look at what's happening for the year. And I'll just grab that there. We can see that it's totally different again. So this is a really, these are changeable times, obviously, right now on markets.
There's a lot of volatility around the markets at the moment, and we're seeing a lot of markets, the momentum is slowing. It sort of took off earlier, then it slowed down. I mean, it's all of them. All the US markets, their momentum has slowed this year. Our market's slowed this year, but a lot of them have actually slowed this year.
Yep.
And looking, I won't say top heavy, but
except for these ones at the top of the board, though.
Yeah, but even those have had
Straight Times has done excellent, 9% up already.
It needed to, because it was a poor performing index last year, so it was lagging way behind. So that's where we're talking about last year. It had the opportunities are more likely to come from the FTSE and Singapore, and both of those are performing better this year.
Well, look, the Asian markets are actually leading. Clearly, you can see them at the top of the board at the moment. So if we look at Straits Times,
are we allowed to look at charts?
At the top, Tokyo is slightly below at 8.8. Then we've got the Nikkei at 8%. And then coming down from that, the S&P 500 is all the way down here at 5.4% at the moment. Yep. And the All Ordinaries Index at 2.5%. So we still haven't quite caught up and passed the US market at the moment.
I'm not worried about it. I think we will. I think we'll do much better than the S&P 500, and this is where we're changing that guard, so to speak. So at the moment, ours has just been held back a little bit, but I don't know whether the S&P 500 and the Dow and that went up last week simply because the stimulus package got approved, because it's a bit different times right now with that stimulus package, because bond yields are going up too. And the last stimulus packages, the bond yields weren't going up. And if bond yields are going up, the big end of town are going to be looking at bonds and taking money out of the stock market. And what are they going to be taking it out of? Which stocks? They're going to be taking out a lot of the big ones, aren't they?
Potentially.
So, and what was going heavy last year, which was technology. So that maybe if they go to bonds, they're going to be taking more out of technology and some of those
Sometimes
other big
I think it's like the news catching up to what's already happened. So, you know, the bonds yields are going up. The money's already come out of the tech stocks, potentially already gone in there.
It's possibly already gone in there. So it'd be amazing to see if bond yields continue to rise, or they'd still keep thinking, because what they want to do is obviously stimulate the economy, but then they want to manage, you know, interest rates, they want to manage the inflation rate and everything else. So, but it'd be interesting to see what the bond market does.
Yeah, I agree.
So where to next?
So if we look at the chart of the Hang Seng, so you can see there's the monthly chart of the Hang Seng. We can see that it's actually pushed up strongly and moving higher. So look, that's one of the markets that we use to compare the Australian market, and its performance looking quite nicely at the moment.
Cool.
All right, we've got a video question actually. It's our only video question for tonight, and well done, Francois. I think we should get straight into the video, shouldn't we?
Absolutely.
Hi Dale and Janine, Francois here. Just wondering if I can quickly ask about the rebalancing of the AX 200 and 300 indexes. Are these some of the companies that we should be looking at for investment opportunities? And if so, should we be looking at the companies that was added to the indexes or removed from the indexes? And a last question about this specific stock. I'm looking at Bush Bay Holdings. It looks like there could be a possible entry, Dow entry at 175. I don't own the stock, but would be keen on getting in. Your views much appreciated. Thank you. Bye.
Cool. What a great question, wasn't it? Well, sorry, two questions that Francois asked us. So I think the first one, where he's talking about the indices, you know, the rebalancing of the indices. Now, I'm not sure how people know when they ever get rebalanced.
Yeah.
Because the ASX don't send out these big announcements going, we've changed the index.
Well,
So-
stocks, there are announcements that come out when stocks move from one index to another.
Yeah, and we see that. So what's your take on that? So if something gets put into the ASX 200 or ASX 300...
Look, he was talking about whether they go out or come in, and I think if they come into an index that's higher, so say for example that they're outside the 200 and then a stock comes in, yeah, definitely that's a good stock to keep an eye on, because the fund managers are going to be picking that up. If it's going out, then I would think maybe stay away from it, because the opposite can happen. The share price could fall because they're actually moving the other way. So.
Yeah, but would you be watching the 200 and the 300, or would you be watching the 100 more?
Look, I'd watch the 100 more, but I mean, that's essentially because that's what we do in managing our client funds. We're looking for stocks in the top 100 because they're the most liquid stocks. But someone who's an individual trader could be looking for stocks that are coming into the 200, because as an individual, you know, you may not have the money that's going to push the share price. You still need to look at volume and see whether you would have an influence on the stock, but it's probably unlikely that most people will be able to move.
Yeah, I was just thinking of, you know, obviously the higher the index, meaning the 200, the 100, the 50, then the 20, the more money goes into that index. So the more when a stock moves into it, the more the bigger end of town is putting more money into it.
Sure, but you can still get some good growth from those ones that are coming into the 200. Okay. However, there's some great stocks that have been coming into the bottom 200 over the years that have then gone on and moved up higher. So people can make some good gains. I mean, there are some stocks in the bottom of the 100 which are not liquid enough for us.
Yeah, absolutely.
But are liquid enough for individuals.
Okay, so let's get off that and we'll get on to the stock that he's talking about. Now, he bought in at $1.75.
Oh, he was actually suggesting that was a potential buy at 175.
Ah, yes, he was. So it looks like an entry at $1.75 in Dow 9, but he's looking to get into it. I'm interesting. He's looking at $1.75 because he's looking obviously at a weekly chart. Now, Francois has done our trading mentor course a few months back. So he's looking at some rules that we've got from the trading mentor course to get in. Look, I think he's fine. I think it's looking good. What do you reckon?
Look, big picture-wise, I don't have enough data. For me, there's only just, like, you might be able to get around 4 years of data, maybe 3 years of data, 4. I like 5 years minimum to see what's going on with the stock, and I don't have enough information there for me personally, but I'd suggest that the stock could rise to around $1.90, $2 anyway before it meets resistance.
Well, Francois and I have had a beer and he's bought me the beer, so that was even better. So I like what he's picked. And now, Francois, it's my shout for beer next time we meet, and when they finally, now they're finally letting us out and socialising. I don't think I've been in the city almost since when I actually saw Francois, met him the first time, which was early March last year.
Right.
So I don't think I'm pretty sure I haven't been in the city since I met him. So anyway, about time we organised another time to catch up. But let's get into our next question. But thank you for that one, Francois. So our first actual email question tonight is from Steve, who says, "Hi Dale and Janine, love the show. My question is, which you sort of explained in a similar question last week is regarding bars, candles, and he's got Heikin, Ashai, etc., etc. Now, personally, I always use candles when evaluating a stock's direction in a weekly, monthly chart, but I really find Heikin Ashai charts most helpful. I can't even say it, Janine. You also see I'm an old auto spray painter, and I've a lot of experience in rounding and feathering out edges, and the concept of a Heikin Ashai does a similar thing with charts. In my opinion, it takes a percentage of yesterday's stock market, for example, and combines it with today's results. And this in turn feathers out the rough edges and shows a smoother direction of the stock. I like to use them when drawing lines to see which way the market is moving and then compare it with the candles. And he's asking really what our thoughts are on that sort of stuff. And I actually had a look at them today because I'd never really looked at those charts before, and they're not even, you can't even bring them up in Optima, and I wouldn't use them at all.
Well, actually, I like his comments about feathering and smoothing things out, because I can imagine that he's a very creative type person and likes to see the finished product at the end. So with the candlestick charts, he's just standing back and having a good look at direction. I don't know. I mean, I started using candlestick charts really early on, and then I actually went away from that after you and I had numerous conversations about the candlestick charts. So they're still good, but I think bar charts, you can't beat them for direction.
Yeah, you can't, and you can't beat them for looking at the emotions of the market and finding peaks and troughs. I find it a little bit harder on candlesticks, but candlesticks and bar charts display exactly the same information.
Yeah, you did do an example of that recently. On one
yeah,
of the
we
shows.
did, but these Heikin Ashai charts are different. What they're doing is actually taking, and I can't remember the actual calculations, it's like they take today's close and yesterday's close and take the midpoint of that, and then yesterday's high and today's high, and take a midpoint of yesterday's bar and then plonk that in, and then draw another candle for today. So that's what he means by smoothing.
Look, it's a study in itself.
It is a study in itself, but I'm struggling to find the advantage in that. I really am.
People used to talk to me about this sort of smoothing effect when you look at Gann swing charts, because you can actually allow more bars into the swing.
But that's different. That's just showing direction and strength.
It is, but it's similar in terms of the concept of thinking about how to smooth things out. And I don't know, take a line chart, that'll smooth things out.
Well, that was my suggestion, because a line chart smooths it out, or even if you just use the moving average, and that just follow the moving average, that will smooth out your trend as well. But when you take the calculations like that and you draw the bar, to me, I don't know whether I'm a purist or not.
Probably.
I probably am, but the candlestick chart shows you all of the data as it was, the high, the low, the open, the close. The bar chart shows the high, the low, the open and close. Exactly. This type of chart takes out some of that data and averages it. So what you're seeing on the screen is not actually what the stock traded at that day.
Yeah.
It's an average over a couple of days, and that's where I have a little issue with that, because I don't see the advantage. I really don't.
Look, there is an advantage if things get spiked around. So I could understand in lower liquidity stocks where there's a lot of noise, and you want to try to smooth out some of that noise and then be able to, to trade the overall direction without getting sort of sucked into those volatility moves. So I can see a little advantage for that, for the more volatile stocks, but I think you've got to look at the raw data, mate. I mean, when you've got a car there and you're looking at it in its raw form, you need to look at the data in its raw form, just like you would a bar chart.
Because your price analysis would change, some of your other analysis would all change. You'd have to accommodate this type of chart. Look, if it works for you, it works for you. I'm not even going to say basically if it's not broke, don't fix it. So if it works for you, that's fine. I don't have an issue with that. But would I personally use it? No, I'm not really
So you went soft on that one, didn't you?
No, I didn't. I went...
Next
What do you want me to do? Smack him over the head and say, don't do that?
He's probably a lot bigger than you.
He probably is.
Next we have a question from Sanjay. Hi Dale and Janine, you guys provided the best show on YouTube for retail trader. Thank you very much. Oh, thank you so much. And I'm just wondering why the market is down recently, especially technology sector as bond yield is up, or may be other reasons as well. Do you think people selling off technology stocks as they're expecting interest will go up in future? What is your view on Zip Company and its chart? All right, do you want to talk about the technology side, and I'll just get the chart?
To me, it's just it's a whole. The stock market is about a pendulum swinging, and so stocks will go from undervalued to overvalued, and then to undervalued, then to overvalued, and they just keep going backwards and forwards. And now on chart they look like that. So that's what's happening, and that's really the technology stocks ran a lot harder last year, so they're going to slow down on their momentum, and what wasn't going hard last year, the pendulum will switch and the money will switch, because what will happen is if you have a stock at $1 1 year and within 12 months it's now at $5, people will still remember it's $1 and $2 and $3, but then it gets too expensive for people, so then they start taking profits. And people stop buying it because they think, well, geez, only 6 months ago.
You're trying to simplify this, I understand.
Yeah, I'm trying to simplify
it's more complicated than that.
But you're better off buying stocks that are lower in price. So everybody switches to finding stocks lower, not higher.
Yep.
And so the technology stocks, because they moved pretty high, then they're coming down again. And so that's why we're seeing your Afterpays and all those ones coming back, because they need to, because they get to that overheated where they outpace their fundamental valuation, and Tesla is probably the prime example of that. At one stage, I was talking with Jim Beach on my show with him last week on Talking Wealth for my show, and I said Tesla was valued at its highest price recently, was valued at 5 times Apple. Its profits and revenue and that was valued at 5 times more, but the share price, because of that's with the share price, but it doesn't make anywhere near as much money as Apple. Toyota's the number one.
You mean the stock market valued it?
Yeah,
5
the
times?
Pricing of the stock market was valued at 5 times what they value Apple at, and yet Apple makes truckloads more money than Tesla. Toyota sells more cars than anybody else on the planet, right? But Tesla's valued more than Toyota, and Toyota makes more money.
Well, I think
so. That's what I mean. It was overvalued, so it needed to come back.
Okay, I think we better get on to the stock chart.
Oh, do we have to?
Looking at Zipco, we've been asked to look at an example of a really volatile stock.
Yeah.
So we have a bit of a look at. I just want to bring up something so that we can see what's going on, and just as an example, this is the weekly chart that I'm looking at the moment. I've got the monthly on the left, but we're seeing 900% in a matter of a few months. It's massive. So that's a sort of volatility, but the stock, of course, can come down just as quickly. And in fact, look at this rise here to the February high in 2021. Just in a matter of 3 months, it's wiped out nearly all of the gains that it made just prior to that.
That's weeks.
Sorry, weeks. Just in a matter of 3 weeks, it's wiped out the gains that it's made as it ran up from the 22 January.
It's huge.
It's so volatile. So, Zipco, I think, is interesting, but you've got to be very careful trading this share, because I think if it was me and I was looking to trade it from a growth type perspective, I'd be looking to trade that out on the daily chart. I wouldn't be looking at a stock like this to try to stay in there, because history's telling you that if you try to do that, look what you're going to get.
Yeah. So right now, people will be going, wow, that's cheap. And this is the thing, is because, not too long ago, it was like, whatever it was, what was the price there? $14.50 or whatever it is, or more than that. So it's $14.40, $14.53 it was. It's now down it closed yesterday at $8.75. So we're talking about a huge, huge drop in price, and there'd be people out there now trying to buy this stock thinking it's cheap.
So you can buy this on good rules, right, on the weekly chart, but then the problem comes when you try to sell it. So that's why
I wouldn't be buying it right now.
No, I wouldn't be buying it right now either, because there's no rule to enter. But I'm saying, like, in the past, if you look at the history and what it shows, that's what you have to learn from.
Yeah. I mean, yesterday on my market report, just to wrap up on this one, is, I was saying to people that stocks will move down, they move back up, they move down, they move back up, they move down, they move back in a downward move, but they do the opposite on an uptrend, where they move up and down and up and down and up and down and up and down. And right now, any move up now could be just a counter move to this big long downtrend that's likely to keep going. And I think there's no reason why at this point in time, there's not telling me it's going to go up, but it could go a lot lower.
Okay, we've got another
saying.
question.
So now we do have another question. This one is from Fawad. I think that's how you say it, so hopefully I did say that right. The next question we have is from, hi guys, he says, I love your talks, I'm very informative and I'm keeping my eye on 3DP. What do you guys think about this company? 3DP is a stock that I started looking at a few weeks back. It's in 3D printing. So it is looking interesting. It's a lower cap stock. They've got a lot of contracts offshore and everything else. And it's already risen too hard. That's why I had a quick look at it, because I had somebody else ask me, but it is a low cap speculative stock below what we want, but I wouldn't be getting into it right now, I don't think, because of where it is. I just think it's too volatile, because what happens is they're coming out with all these news, all these contracts, but the people in the know had already bought the stock already. They take it to that high prices, and now all the announcements are coming out, all people saying, wow, we should be getting into this, and they're selling into that. Yeah, that's already
too late, suckers.
It's way, way too late. And to me, that's just a sucker's, you know, you might be getting into it just as everybody else is taking profits.
All right, now I've brought the chart up on the screen there, and I've just put a volume histogram on the bottom there so we can see what sort of volume has happened over time. So say, just to get an idea for how illiquid this share is, the volume over the past couple of months has sort of been around that 9 million there?
Yeah, 9 million shares, yeah.
Yeah, and you're talking about a share that's worth less than $1. So it's a very low liquidity. So yeah, you could expect to see these sort of rises, but look what it does when it falls. You can drop out of bed just quicker than the other share, the Zip one that we just looked at.
Yeah, I mean, I understand people looking at these stocks or finding them in chat forums or wherever they find them and go, wow, it's only 50 cents. It's risen this much.
You're more likely to lose than you are to win on a lot of those shares.
And that's what I'm not understanding is that it's that risk that we're going to talk a bit about tonight. So when we get into that, but I probably that's a nice segue into our main topic for tonight, because I really think it's time to get into our topic to really talk a bit about that. And really, our topic tonight is about finding growth stocks in 2021. So better than what we're looking at the moment. Now, how to minimise risk while maximising your profits is the title. Now, it's no secret that everyone wants strong returns in the stock market, and finding stocks that will deliver the required growth whilst managing risk can be a major challenge, but it need not be. And that is what Janine and I hear or help traders with all of the time. Now, the fact is that investors will often say they want to invest in high growth stocks. However, I suggest that they do so without consideration for the risks they are taking, because as the saying goes, the higher the risk, the higher the reward. And here is where the little greedy bug really starts to creep in. Now, unfortunately, this kind of thinking leads investors to being unprepared when the market or the stock market they're investing in changes direction. Now, whilst intellectually people know that they can lose, not many consider this when they're investing, as they are focusing on what they can make, which is like stocks we just saw.
Yeah. So, how do you achieve double-digit returns in the stock market while minimising your risk?
Ask Janine.
In tonight's show, that's exactly what Dale and I want to discuss. However, it's more than that, as we'll get into why investors make the critical mistake of taking on too much risk, and in doing so, we'll share with you our thoughts so you can avoid doing exactly that yourself. Before we finish up, we'll also share how you can search for stocks that have a high probability of providing double-digit returns and do so without the risk of losing your shirt. Lastly, we're going to demonstrate how to minimise your risk while maximising profits by revealing the 3 most important risk management techniques used by professionals that you can start using straight away. That'll help one.
It's so important, isn't it? It so is. But, well, first up, you might ask why we want to share topics like this instead of just talking about stocks. Well, because we could do that till the cows come home, can't we, Janine?
Definitely.
Well, the simple answer is we want to assist you to be safe in the market, and so you can make more money, as just talking about stocks or getting stock tips is absolutely not the answer to long-term successful investing or trading, and it never will be. Now, Janine and I believe your number one priority should always be risk ahead of making profits. Now, this is simply a case of cause and effect. If you look after risk, the profits come and come more consistently and in bigger amounts. Now, this is in vast contrast to what the many videos we see each day popping up on YouTube and other websites. Now, the cold reality is that your ability to manage your risk well each and every day is the key to creating and holding onto your profits in the years ahead. Now, you can mark my words on that one.
I'll remember that.
I'm sure you will.
Having assisted thousands of people to achieve their goals in the stock market, we found most start out focused on higher risk, lower capitalised stocks, and they're thinking about how much money they can make rather than having a plan to be profitable. Having a plan to be profitable is vastly different to thinking about how much money you can make. Having a plan to be profitable means thinking like a trader and managing a well thought out process, which includes analysis, rules, and importantly, managing risk. Part of managing risk is working out what you might lose if a trade goes against you, and this lack of plan results in a lack of focus, and this results in people taking unnecessary risks, which means this results in, you guessed it, inconsistency and poor performance. Now, we chat with people all the time who want to learn to trade, and most share that they don't want to take high risk, but when we get into conversation, what they share, how they've been trading up to this point, is really disturbing. So most either had no, indeed, or lacked any real plan to profit, and worse, they lacked a proper risk management process when they were trading. The majority have no idea about how to properly construct a portfolio, along with having no structure around selecting suitable stocks to suit the level of risk they would like to take. Now, this meant they were exposed to much higher risks than they realised. In fact, once our students learn how to trade properly, they are gobsmacked at how much risk they were taking on, not realising it. So you may be sitting there thinking to yourself, that's not me, as I know what I'm doing. Others are saying, yes, that's me, Janine, that you're talking about.
I really do think that's an important point, as some people really have a cognitive bias and really can't see the wood for the trees in all of that. And after all, we don't know what we don't know, and I know I've had way too many conversations with mainly guys who tell me they're trading well, yet they contacted us. And so that speaks volumes for itself. But when I drill down a little with them and find out that they're way overestimating the level of knowledge and skill, and somewhere inside of themselves they actually know it, and hence that's really why they contacted us. Now, getting back to risk, Janine, you and I chatted about why people take unnecessary risk at length, and in fact I think this is one of the favourite things we actually talk about. We share some interesting insights and let everyone into our conversation, because this is something we talk about all the time now. But I can share something with everyone first, and it's an illustration. I think the guys have brought it up on the screen, and I found it on a website called quotemaster.org, but I'm not sure who drew it. Now, whilst this is a cartoon, this image is so on the money when it comes to trading. It's seriously not funny. It shows how people's risk analysis is wrong or flawed, and it shows how people handle risk management. And it's really what we see all the time, isn't it?
I think that's really cute. We know the number one reason why people take much higher risks than they need to is simply a lack of knowledge. Don't just take it from us. There is a quote from Warren Buffett that states, risk comes from not knowing what you're doing. Now, the issue we find is that a lot of traders will not admit that they don't know what they are doing. So that's part of the problem, isn't it?
Okay, Janine, so just because I don't know there's a bullet in the gun, does that make the gun less dangerous and risky? Or should I just assume it's dangerous and treat it that way? Or should I just say, I know what I'm doing and ignore the risk? Sounds like famous last words to me.
Good point. But if we know a lack of knowledge causes people to take higher risk, what did we find drives them to do it?
Good question. That is a really good question. Well, first one I think is human psychology. I really do think it's psychology, and that's the first thing. And I know people think, "Oh, just teach me to buy and sell," But we talk about fear and greed a lot. You and me, we do it. Yeah. We're always talking about it. And one thing people watching these videos, us, is we keep repeating the most critical stuff over and over and over and over.
Oh, you're talking about cycles in the market and how people do the same things over and over again.
People do the same things over and over, and that's why we get herd mentality. Doesn't matter what decade it is, we still get the same things happening. Yep. People, the newbies who get into the stock market, they always pick the CRAP stocks, like we've seen a couple tonight. They tick the low end of the market, the low liquidity in the market, because they think they're going to make more money because they don't have much money. But really, I think the big reason is people are, for want of a better way of saying it, I think it's fundamentally lazy. And it's not really that they're lazy.
But you often say that, though.
Yeah, but it's not really that they're lazy, but it's a word that I can say that people understand, but it's really a fear of failure. And a fear of failure means that if people go, well, I've got a fear of failure, but if I don't really try, then I haven't really failed.
Yeah, or they'll say that I don't think I can do it.
Yeah, so they put all this stuff in there, so therefore they don't put the required effort in, and therefore they fail, and then they validate exactly what they thought in the first place. So it's not that they're lazy, But if we said to them, I know if I said to people, I can guarantee you 100% that you'll make X amount of dollars in the next 12 months if you follow this strategy.
Everyone would do it.
Everyone would do it. And I said, if you don't make it, I'll pay the difference.
Yeah.
And everybody will put their hand up and do it. But life doesn't have guarantees, and no to the stock market.
I'd laugh at that. Can you just you can offer that one on the show? The other one is chasing returns out of a need to make a quick buck. Now, how many people have you seen who have done that? And part of the issue around that is often we find that there are people who have sort of left things too late. You know, in their mind, you know, they're getting older.
FOMO.
No, it's not so much FOMO. It's an age thing, I think. And so you find people who are logical people who are really sensible, but as they get a bit older, they just tend to end up doing silly things because they're chasing the returns because they're worried about whether they're going to have enough for retirement.
It's interesting, isn't it, how some of the people more senior in the society are taking some of the biggest risks to play catch-up, and that's the worst time you should be doing it.
That is the worst time. So their investment timeline's shorter in a lot of cases that they've been procrastinating, and that's what's caused their investment timeline to be shorter.
Procrastination works, doesn't it?
Procrastination kills, actually, doesn't it? Kills returns.
It kills everything. No, okay, Janine, now time to ask the tough question, so you're ready for it. When someone's taking on high risk in the market, what does that mean to you?
Yeah, look, it means a number of different things, but really, I think the first thing's really, it's a common thing, and it's about a person's level of knowledge. That's one of the foremost things, really, in the market.
Okay, so their knowledge, their skills, experience in the market.
Yeah, so the knowledge comes first, but then you've got to develop the skill, and that's one of the things that people think about, sort of in sport. You know, it's all right to actually be told that this is how you kick a footy, but you've actually got to spend time doing it and then actually get experience on the footy field in a game. It's no point just kicking the footy at the goals and then think, I know how to play football. No, you don't.
They do. They need to develop the level of knowledge and skills and experience congruent with what they want to trade.
Yeah.
Now, all too often we find people want to start off in the highest risk areas like FX trading or whatever it is, or options, you name it, CFDs, because they think I'm going to make a lot of money because of that greedy bug hitting in. But that requires a whole completely different levels of knowledge, experience and skills to do that.
Yeah, I'd like to have driven a Ferrari.
When you were 16?
When I was 18, I would have loved it. Yeah. However, would that have been a sensible thing to do? No. I mean, should I have tried? Maybe, but that would have been a very dangerous, I mean, it would have been illegal for a start. And yet we allow people who have got no skills and experience in the market to take massive risks that they don't even understand that they're taking.
Oh, absolutely.
And I guess the sad part is that we've seen a lot of people really hurt themselves, that their future and their family.
People do dumb things, don't they?
Because it actually puts them back. They might win for a while, but it's what happens after that that's the real concern, isn't it?
Okay. So the next point we want to talk a bit about is how well risk is being managed. You know, to me, how well risk is being managed is really about the process and the rules that investors and traders use. And I know we talk about this a lot, about having rules, having a process, and a lot of people just pick stocks because I don't know how many times I get, I say to people, why did you pick that stock? And they go, oh, I saw it in this newspaper or this newsletter, or I saw it on a chat forum. And I go, what research have you done? Nothing, but everybody else had done it.
Actually, we say proper rules, right? So, because people could have rules, but are they proper rules?
No. Most people don't even have proper rules. When you ask them to explain it, they can't articulate it properly. So that was one of the things. But the type of investment traded is also a real major factor in the type of what they're actually doing, because, again, it needs to be congruent with who you are.
Yeah, it's crazy to go out and trade something if deep down you're doing it just because you think that's the way to make a quick buck, or because my friends are doing it. I mean, particularly for young guys, I'm saying this for, who can be influenced. Oh, my mate's doing this. How many people have we had call us and said, oh, my mate's doing this, I want to go and trade that way? We try to slow people down, actually, and say, look, take a view that's 5-10 years out from now, not trying to do what you're wanting to do in 12 months and then you crash and burn.
The people that I mentor when we're mentoring through teaching in the trade, one of the first things I actually say to them is expect that people are going to get in your ear and want you to trade all these different speculative things or high risk stuff, but stay true to yourself. Don't listen to them. Stay different. Stay independent for that. Get through the process, and then you'll be really successful. But if you buy into all of that, you're going to get distracted and you're not going to get to where you want to go. Because I thought it was really, really critical we have to do that with people.
Yeah. Look, we're going to talk about the three most important risk management techniques that anyone can start using today. Now, these are all in Dale's book. So, Dale, which technique do you see as the most important one from your book?
Geez, which one? How do I narrow it down to one?
You just said it's easy.
Well, it is easy. The first is money management. The second is money management. And guess what the third is? Money management.
You're making this
You
boring.
guessed it. It really is. It's money management, money management, money.
All right.
And I've been in a room full of financial advisors and accountants and people like that. And I've said to them, I can just get you to throw darts at walls with stock codes on it and I'll make money out of that because of the money management. And that's how important I think money management is to
A lot of people don't understand what you're talking about. So what are you going to say? Read the book?
Yeah.
It's all in your book, isn't it?
Okay, so why? Sure.
So why do you consider this number one?
So why am I considering number one? Well, they can read that in my book, but in fact, both books, How to Beat the Managed Funds by 20% and Accelerate Your Wealth, It's Your Money, Your Choice, both have this in it. But it really does remind me of a quote from Alice in Wonderland by that Lewis Carroll, who wrote Alice in Wonderland, and the quote that he put in the book, or the part of the book, he says, "Would you tell me, please, which way I ought to go from here?" said Alice. "That depends on a good deal on where you want to get to," said the cat. "Now, I don't much care where," said Alice. "Then it doesn't matter which way you go," said the cat. And to me, money management is a roadmap to where you're going, and it's about planning to be successful and getting where you desire, not just getting anywhere. So when people read my book, they will learn about capital allocation, position sizing, risk, stop loss, exit strategies, entry strategies, and so much more, which are all part of money management. Even understanding different markets and the risks associated with those different markets is part of money management. People think money management is just how much money I put on a stock.
Yeah.
And it's not. It's just so much more than that.
Now, I believe number two is what you briefly mentioned, and that is setting a proper stop loss. You guys have heard us talk about that before. In the book, we share a standard 15% stop loss. However, this could vary depending on your strategy and the rules that you have selected for particular stocks. So let's demonstrate how the 15% stop loss is applied on a chart, shall we?
I'm surprised I said something briefly.
Okay.
We're going on the charts now, yeah?
Yeah, we've actually got, now this is actually the energy sector, okay? So it doesn't matter whether it's a stock or market. And I'll just look at the sector chart. Now let's just say, for argument's sake, that you entered in the energy sector. We just put a blue line to mark where we entered. So you decided to buy some stocks in the energy sector when they traded up through this point.
Okay.
And then as the stocks or the market continued to rise, then, obviously you're in profit. So what most people do is they're sitting there looking at the fact that they're in profit, forgetting about the fact that the stock could turn around or the market could turn around and go straight back through their buy price. Yeah. Because they're only thinking about what they can make, not what they might lose. So by setting a stop loss, you're setting a 15% stop loss, but just to get an idea, and this is why charting is so important, because it's actually important to see where that 15% is and understand what that means from the chart perspective.
What's the line in the sand of going, that's enough?
Yeah.
And I've had
There's two sides to that. It's what you're saying about, okay, there's a line in the sand that says 15%. Okay, well, when we first started talking about stop losses, it was always about the percentage. And I said to you, hang on, people are not getting the fact that because they're not seeing it in dollar terms, and people need to really understand the dollar value of that stop loss. So you go away and calculate how much money that you're going to put into each of the positions, then you calculate that stop loss, if 15%, 10%, whatever that is, in dollar terms and how much you're risking, and say, well, to yourself, honestly, in the light of day, am I comfortable risking that amount? And if you're not, then two things can happen. Either you've got to change the stop loss, or you've actually got to reduce the amount that you're trading with. So the allocation of capital to that trade. So just back to the chart, if we come back to that and just have a quick look, that if the stock or market went back through that level, there's a serious problem.
Correct.
With that trade right there and then.
Exit at that point.
So that would be telling you on the chart that that's the case, even before you look at your stop loss.
Okay, so that's from the initial stop loss. So what's number three?
Number three has got to be using a trailing stop loss. Now, this could include a trend line to manage the trade once you've invested. Dale explains in simple terms in his books. So if you still haven't bought yourself a copy, what are you waiting for? Do it now. And if you know that you're really serious about making money in the market, then you're welcome to contact the office and chat to one of our education consultants who've studied our courses. These people are traders themselves, and they'll explain what your options are. And there are different courses to suit your needs and your budget. So that's really important that we can do that for you.
And we're going to talk about trailing stop loss now?
Yeah, so look, if for a trailing stop loss, this is a totally different ball game, isn't it? Because we're talking about once the stock or market is actually in a profitable position and you're able to manage that. Now, there are different rules to manage it. So some people, what they do is they buy Dale's book, and this can work for quite a few stocks, they'll put a trend line under the chart and say, okay, I'm going to sell based on the rules in your book.
Yep.
But we know, based on our experience and knowledge, that a lot of stocks will work well on trend lines, but some stocks, to get a better result, you need to actually trade with a different rule.
Different rules, yeah.
Yeah, so that's why in the course we explain all of that, and we actually allow you to become the master of working that out. Now, people might sit there and think to themselves, I haven't got a technical bone in my body, it's not really me.
You don't need a technical bone in your body.
But you really don't.
You need a $2 calculator.
That's how you started, isn't it?
There's a $2 calculator. That's how I started. I can still trade with a $2 calculator. Don't need anything scientific.
Yeah. So, coming back to the charts and what we were talking about, obviously the trend is up here. So the index itself has started moving up, and I need a trend. You've got all sorts of lines here. What are you doing?
I'm trying to make it complex for you.
Okay. Now, so obviously the trend is moving in this direction.
Yeah.
Okay.
Yeah.
But what happens is people look at that and they say, okay, there's my trailing stop loss, but the stock could fall all the way back to
they're worried about that.
This line, and they're worried about that.
I wouldn't be.
You wouldn't be, because what you found in the past is the fact that often stocks can come back to those lines and they'll bounce back off them again.
And they may not even come back to that, but that still wouldn't worry me.
Yeah, because and if it trades below it, what are you going to do?
I'm going to exit.
Okay, but there's special rules around how you do that, and that's what we teach in the course as well. How to master that. And this is not just about putting a line on a chart. It's about a process for you. Okay, so this is only one very small part in a process that you can master, so that you go into the market and you don't even feel it in the guts anymore when you take that trade. You're in the market, you know how you're going to trade. I did, this week I actually put an article out for one of the guys who's one of our traders, one of our students.
Oh, the full-time traders, yeah?
Yeah, finished the course, and it's just changed his whole life. Him and his wife, he's now retired.
15 minutes earlier.
Yeah, he's retired 15 years earlier than he otherwise would. And he said that he doesn't feel it in the guts anymore, and that's exactly what you've got to get to that point where you don't. And to me, that's a great achievement. We feel fantastic about it because we've actually contributed to somebody's life.
All right, Janine, I know you're really keen to get on some super charts so that we can show everybody the stocks that are so good for growth right now. So what are we going to show everybody here?
All right. So I'll get off my soapbox now for a little bit.
You don't have to.
Oh, okay. So I love talking about the charts, as you know.
I don't have my sock here from last week.
So how to find stocks that are likely to provide double-digit returns. That's what we're talking about. And there are you can either take a simple process to do this or a more complex process. It depends on where you're at with your knowledge and your training. We're obviously taking a more simple process tonight. Because you've already seen us talk about sector analysis on the show before, I've taken a couple of sectors that we've been talking about and a couple that we haven't been talking about on the show so far, but sectors that typically provide growth type stocks.
Okay, so we are going to look at some growth stocks.
Yeah. Okay, so we want some stocks that produce growth. But first of all, if we look in the at the sectors.
So before we get into that, we're going to look at the sectors that we talking.
Yeah, we want to actually have a look at some growth stocks to start with. And
then we are. Okay, sorry.
No, we want to look at some growth stocks, but we actually want to get to find growth. Tell them how to find those growth stocks
first before we get into the growth stocks.
Yeah, so to look at the sectors as part of that process. So here you can see I've got the energy sector. Now, while at times this sector actually falls quite strongly, it actually can produce some really good growth from some of the stocks within that sector. These sorts of runs, this chart only goes back to 2001 because this is when the sector charts first started being recorded on the Australian market, unfortunately. However, some of the stocks, in the energy sector produce really good runs going back, decades.
Yeah, they do.
So I'm just looking here, and you can see, to me, this looks really positive for the sector so
really
far.
Bullish, doesn't it?
If it turned and started to pull back strongly, then obviously it'd be a watch again. But you'd have some stocks on your watch list that are in this sector. The next one I've got, just looking at the sectors, is information technology. Now we can see there that at times this sector trends up really nicely, and more recently we've seen the sector go quite vertical. Right now, at times these trends can last 12 months, they can last 18 months, they could last 3 years. And so that's a really good thing to look for when you're looking for a growth stock, to look at a growth area in the market.
Yeah, don't look for short-term
Don't look for
spikes.
short-term spikes. That's just a waste of time. You want these really long ones. Materials is another one. We know that historically, if you go right back, now BHPs and Rio and FMG are all really good examples of those type of shares.
Well, they're examples of stocks that will do 20% per annum quite regularly.
Well, we're looking at this sector, and obviously it only goes back to 2001, as I said, but there was a big long run up. There's been really good runs over the years for all of those stocks, even if they have some periods of extended decline, like we saw in the correction that happened in the mining sector into 2015 here. But since then, we've actually seen a really nice move up. Now, I'm really, as you know, people who have watched previous shows, I'm really interested in this sector long term.
Correct.
And there'll be some really good opportunities coming up. So we're not quite through that all-time high yet. I think there's a lot of further upside to go. So looking at industrials. Now, industrials hasn't moved on since the pullback that we saw during COVID. So to me, there's some opportunity there. Clearly, we can see they're still not through the all-time high or the pre-COVID low.
Great stocks to buy in that one.
Potentially, there could be some really good stocks in this one. And then we've got the mid-cap 50. So people looking for growth stocks, typically.
Perfect spot.
You might look at stocks that are in the mid-cap 50. So they're still nice and liquid for individuals, but they're outside of that top 50. Okay. I mean, I personally think the Australian markets, the stocks in the top 50 on the Australian market, they're good for growth.
They are.
And there'll be times when even finance and bank stocks, which are typically more plotters that pay dividend and income,
they'll do 20%.
That are balanced, they'll do good growth.
Well, I know Cochlear CSL, if you look at the long-term growth of those over 10 and 20 years, they slam 20% per annum.
Yeah, look, I mean, ResMed, the healthcare, I purposely didn't put the healthcare sector on there because at the moment we're seeing CSL in decline. And some of the healthcare stocks have been sideways and pulling up, but they will be good opportunities at some point as well. So I wanted to put so much into this, but I could hear Dale's voice in my head saying, Janine, cut it down.
I have to go to bed tonight. Eventually. So we're going to look at some stocks now? Or what are we
just
doing?
quickly, I want to show this watch list of the mid-cap 50.
Hold on to horses.
On the chart there, you can see these are all the types of stocks. Dale was mentioning before some of the healthcare, like we've got ResMed, APT, which people will be excited to see, and I've got a chart of that coming up. Xero is another interesting
Financial,
one.
Whitehaven Coal, New Steel, Coca-Cola, BlueScope, Tabcorp.
Yeah, now you're probably thinking, I've got some of these in my portfolio that you hear Dale reading off.
Minerals.
These are ordered according to market cap. You don't have to go down to the bottom of the barrel and drudge what's down in the bottom of the barrel to find really good stocks. Some of these stocks rise to the top at times, and that's where you should be looking, in my opinion. So here we've got Santos as an example of a growth.
Now we're getting into the stocks.
Now we're getting into some juicy stocks. Now I've purposely I've shown you the mid-cap 50 because there are some gems in there. So obviously go and have a look at the list of mid-cap 50 stocks if you can get access to the mid-cap 50 list, and have a look at how those stocks are trending. Then look at some of these big stocks, like Santos is a great
magic stock
company. It's a highly volatile share though. So that's why, growth stocks are going to be the ones that don't necessarily pay massive dividends.
Yes.
They're going to pay somewhere low dividends or below the market average, typically around the market average or below. But Santos looks like, to me, that it's doing really nicely at the moment.
Really nice.
So at times it will run for maybe 2 to 3 years and then it'll pull back again. So you've just got to be mindful. It's not, none of this stuff is a buy and hold that we're talking about. It's not long term either. For some of these. So APT is another one, even though people are saying to me, oh, look, APT's run so hard, I just think it's not going to be a growth stock down the future. I think these guys are going to I think they're going to still continue to smash it out of the park down the track. We will see a bit of a pullback, but to me, this is opportunity.
Yeah, well, there's just an announcement in the UK actually today. I just saw a post from their founder and CEO today.
Great, but that's all very good and well, but we don't really care about that much, do we? We don't add a lot of weight on that. It's more about, the thing to be mindful of is if the tech sector in the US is running, and you've got to watch that because these stocks in Australia will follow because Australian fund managers are copycats. So just keep an eye on that as well. And then we've got FMG. I like Rio BHP. At times I'll prefer Rio over BHP, and at times we'll pick FMG, but we're waiting and watching FMG to see how it comes back for further opportunities. But again, this is another one like APT. People think, oh, look, it's run so hard. Do you think there'll be opportunities down the track? And absolutely, I do.
There will be. But you're waiting for them to come back to levels before we get into them.
Yeah, look, these are ones that people should be waiting for, because it's down for 2 months at the moment, so it's still falling. We don't know that the low's confirmed yet.
Last one.
Okay, these are all monthly charts again. I've got a split chart there, so you've got weekly and monthly. Now, Transurban has really underperformed big time. So Sydney Airports is the same. Now, this is a a stock that has, as you can see, it just trends beautifully over time. Now, it did have a sideways, went sideways for a few years here, but the key is to be on it for when it starts trending up and look for those entry rules when it does. I just think it's a while yet. We need to be patient with this one. So that's an example of another one that can be a good growth stock at times, but not right now.
Wow, this has got to be our longest main topic we've ever done.
Now, you notice I didn't pick the, the bottom of the barrel. People are thinking when you've got to get double-digit returns, you've got to go and pick those little penny stocks. You don't.
No, you don't.
You
You've
can
actually
look
got more
anywhere.
probability of picking it on these ones than those penny dreadfuls that we see all the time.
Yeah, I mean, you can go outside the top 100, as we've talked about in the show, but it can get good stocks in the mid-cap 50 easily and even in the top 50.
All right, there you have it, guys and ladies. So, okay, Janine, that was a lot of ground we covered. So, to me, the principles we mentioned were like, were that the same as the Mad Hatter said to Alice. So, we really do need to decide where we desire to go and set down that path to get you there through proper money management. And only after we know the path, we get into looking at the stocks that fit our plan or the roadmap, and then we add rules around that to manage the risk so we have high probability of arriving at our destination. So it's a step-by-step process through there.
Now let's get into some more emails, but before we do, remember, hit that subscribe button now, and whilst you're there, give us a big thumbs up and click the like button. Thank you very much.
Fantastic.
We've got an email question from Adam. Hello, Janine and Dale. I found a stock that I'd add to my watch list. I do not intend to buy the stock at the moment, as there is no confirmation of a turnaround has begun, but thought I would run it past you both to see if I'm thinking about this the right way. Now, the stock is Z Energy, ZEL. Last price 257, COVID low 247, all-time high 858. It's got a huge market cap of 1.3 billion, sits outside of the top 200 ASX. Not ideal, I know, but hear me out. Investment term, medium to long term, coming off 4-year downtrend, which commenced 2016. Oh, gee, you gave me the big one. Had a small run up on the monthly chart from September 2020, lasting 3 consecutive months, but met resistance at 335. Has now retraced. I need a drink of water. The business appears to be involved in essential aspects of energy supply and related products. Its poor SP performance, most likely a result of COVID shutdowns. It is a New Zealand company trading on ASX. A look at its business suggests this company has plenty of years ahead of it and boasts significant major shareholders. And upside when the time's right. A penny stock for your thoughts. Oh, that's very cute. Thank you.
And I actually took half of that email out. This person's on, I think, module 2 of our course. And I put it in there just to share with you what students can do. And I took half of it out.
And you got me to read it.
And I got you to read it.
And you never would have allowed me to put a big one like that in.
Payback. At least you had an easy name to say.
Payback for all the big ones that were half the size of that.
Well, let's look at the stock anyway. So Z Energy.
Yes.
Okay.
We can see it on the chart there. Code is ZEL, and you can see that it's traded to a new all-time low. So previously its all-time low was in December 2013, but in 2020 with COVID, it actually pushed to a new all-time low.
The volumes on it are CRAP.
Yep. Now it might be pushing out of the bottom there and finding support. There's a possibility it could. So I can understand why this stock might have come up onto your radar. Forgetting the fundamentals, because sometimes when stocks push along a bottom like this, then they can, they're going to go one way or the other eventually. Yeah. But the fact that it made a new all-time low is a concern for me, because often stocks are going to go lower when they've made that new all-time low. So this could be a false rally. It could be the start of a new run, but
could be. It might be just a basing pattern for years.
Yeah,
and you don't know, and that's the point. It's very, very low liquid when you're looking at 486,000 shares, 500, 600,000 shares. So very, very low cap indeed. So I probably wouldn't look at that stock. But I think we've got another question, haven't we? This one is from Jack, who Jack says, "Hi Dale and Janine, as a person who is young and very new to investing, I have a 2-part question related to the ASX share market game." Great question actually so far. Question 1 is, do you think the share market game should be compulsory learning in school? Absolutely. Or do you think schools should have more emphasis on teaching teenagers about the stock market? Absolutely. So I think they should do both, getting into the stock market and using the stock market game. Now, question 2. In the share market game, I bought Aristocrat Leisure at $33.38 on the 11th of March, as I noticed it was in an uptrend. I think I bought a little too late and I'm worried though it's just a game. It might be headed for a downtrend soon as it hit a level of resistance. What do you guys think of the chances of Aristocrat Leisure surpassing the all-time high soon? Great stock he picked.
Actually, first I just wanted to say
congratulations.
I just wanted to say, didn't you go in that stock market game at one stage? And you won?
No, I've never been into it. No.
Oh, okay.
Never, ever. I looked at it for the first time last week, ever.
Yeah, okay.
So, yeah.
All right, there you go. But look, we're looking at ALL here on the screen. Look, it's quite close to its all-time high, but it does look interesting right now. Look, I think potentially it's more likely to rise than fall at this point. But if it were to fall below that low here in March, then of course you would change your view.
Absolutely. I think you've got nothing to worry about at the moment, Jack, so that's pretty good. Now, the next question we have is from Nerida, who says, thank you so much for the effort you two put into the show. Please know that it is appreciated. Now, I started investing in shares in February last year, and I got a bit carried away. I managed to accumulate 21 stocks, which includes 4 ETFs. Now, after reading your book, I'm thinking of culling a few of these. Yes, I like that idea. At the top of my hit list is currently Origin. Now, I have a current loss of 8.72% with an average price of $5.23. It's not the worst performing stock in my portfolio, but I have a lot more faith in the turnaround of the other stocks. I just wonder what your thoughts are on the direction of this stock. Thank you in guidance. I think it's a bit of process stuff we have to answer too, not just the stock.
In terms of buying a certain number of shares?
Well, she wants to cull it down. So when you normally want to cull a portfolio down, what do you normally would do?
Well, first of all, I just go and look at the weightings of all the stocks.
Yep.
And if I'm holding really small, well, we've done this for client portfolios in years gone by. And if they're holding really small percentages of some stocks, then that's just their easy pickings. We'll just get rid of some of those. You know, you'd be looking to put some capital and top up the ones that you might want to keep. But it's all about if they're, you know, what the risk is as well, how much risk they're taking. So that would be another consideration. Can I talk about Origin now, or you still want to talk about the portfolio?
No, you can talk about Origin. That's fine. I don't mind that one.
Okay, fantastic. Looking at the charts now, you can see that I've got the monthly chart on the left-hand side, and the right side is, you know, the weekly chart. Now, we know that energy-type stocks are historically quite volatile.
Yes.
And Origin is one of those. And so don't expect this personality of this share to be calm and nice and trending all the time. It won't be. So that's what we were talking about in the show about risk. If you look at a chart of a stock like this and you think that's really not suiting my personality in terms of the stocks that I want to trade, that would be a way to cull it off the list if it's too volatile for the type of share that she wants to be trading.
Correct. But I often find people think, they go, oh, I don't think this stock's going to recover or do that well, and I think these ones will. But most of it's just most of the time I find people just guess.
Yeah.
And the ones they're thinking of selling are actually the ones that I like the best.
Yeah, well, you've actually got to have a reason. So, like, if the stock was to continue to fall, then I might say, well, okay, it's more likely to fall away and it could take out that low. But what if the stock starts rising next week? Would you hold it?
Yeah, I would. I'd still hold. And to me, don't cull just because in the book says 8 to 12. Don't cull just because of that. Cull because the stock's telling you to get out of it.
Yeah.
So we're not taking higher risk right now. Just slowly get rid of the stocks as they give you sell signals, and that's really all I can say about that. Okay, so that's it on Origin, this one.
Last week I shared an inspiring quote by Benjamin Franklin, and we had some great feedback, so thank you. And I have another quote for you this time from Albert Einstein, who said, "Education is not the learning of facts, but the training of the mind to think." This is so relevant to trading the markets, as so few we talk to really understand how to think through a proper process so that they're successful. Rather, we see the majority follow the herd, thinking that the person leading the charge actually knows the way, when in fact they're just as confused as the majority. So you see this on chat forums. That's what you're talking about, isn't it?
Yeah.
You're investing your time watching our YouTube show in order for you to gain some knowledge around investing and trading stocks. And hopefully you're learning that those who are good are self-directed traders and are not those who follow the herd. So I'd like to thank you. That's to everybody who contributed to the show tonight. The more questions we get, then the more we share our thoughts and knowledge on trading and investing, and the more everyone benefits, which is great. So remember, watching this show is only part of your journey. You may have a question on your mind, or maybe something's holding you back that we can fix for you. So as Dale said, do something, and if you're serious about understanding the stock market and how to consistently profit, then that's something you can do is call us. You can call our office on 1300 858 272 or email either, couldn't get that out. info@wealthwithin.com.au.
Cool. Now, we hope you've enjoyed tonight's show, and may I give a big thank you to those who participated. As always, we're here to help and hope that what we've covered tonight has made things just a little clearer for you and helped you so as to make your journey a little better and a little easier. Now, as always, this is a two-way street and you are actually part of that, so hit the subscribe button and show your support for the team who work hard to bring this show to you each and every week, not just Janine and I.
If you enjoyed this week's show, then put it into your calendar to join us right here on the live Australian Stock Market Show every Tuesday at 7 to 8 p.m. If you would like to have your questions answered on the next show, or if you have a topic that you'd like us to cover, please send in an email to info@wealthwithin.com.au and type Wealth Within Live in the subject line. You must email before 3 p.m. on the day of the show.
Fantastic. Now, as always, thank you for joining us and we hope you have a great week. We look forward to you joining us again next week, but for now, goodbye, good luck and good trading.
Bye for now.